If we're going to avoid catastrophic climate change, only 1/3 of current fossil fuel reserves can be burned. After filing the first shareholder proposal with ExxonMobil asking them to report on carbon asset risk, Arjuna Capital has reached a landmark agreement and withdrawn our proposal. Exxon will be the first oil and gas company to publish a report on how they integrate carbon asset risk into their planning. Shareholder value is at risk if companies aren't prepared for a low-carbon scenario, where market forces and regulation reduce demand for fossil fuels. Despite this risk, oil and gas companies spent $674 billion in 2012 finding and developing new reserves. As new reserves are harder to find, more and more unconventional frontier assets are being booked on the balance sheet, such as deep water, Arctic, and tar sands. These reserves are not only the most carbon-intensive, risky, and expensive to extract, but also the most vulnerable to devaluation. As investors, we want to ensure our company's capital will yield strong returns, and we're not throwing good money at bad. Investors are the canary in the coal mine and will move their money to avoid material risk. Forward-thinking companies need to reassess how they allocate shareholder capital and act strategically to shift their business models. We want to invest in energy companies, not fossil fuel companies. If big oil can't redirect capital to low-carbon energy alternatives, investors will.